Hello and welcome to another video. In today's video, we will be talking about the stock market and how risky is investing in it. So let's start. Is investing in the stock market risky? The answer is no. No, it's not risky. Well, it's not risky if you keep it simple and actually invest in various companies across the board and not gamble. You see, when people talk about the stock market and think about the stock market, they think not about investing, but about day trading, about all those Hollywood films that they see, all those scary news articles and flashing headlines you see. That is not investing, that is trading. Trading is basically gambling because nobody can predict or tell the future. Therefore, you're gambling that the price of this stock will go up or go down. But investing is a different thing. You're investing in a company and you're believing that that company will make a profit. And you're not blindly investing, you're investing from the information of said company by reading its balance book, looking at its historical data and how the company has progressed over a long period of time. Because of day trading and the news, people tend to overestimate the risk associated with stocks and shares. People think that if you invest your money into a company, overnight you're going to lose half of it. Also, people's psychology plays a lot. If you invest in a stock and the stock goes down and you look at the price, you panic and you sell. So ideally, what you want to do is buy low, sell high. What people do is the opposite. They buy high, sell low. And then they tell their friends that they invested in this stock market stuff and they lost money. So it's a scam. Don't invest in it. But it's not a scam. They just didn't do their research. So don't let these people scare you, because the fear of loss leads to missed opportunities and it will impact your long-term financial future. Because while people understand and do the research, they're going to be making money while you are not. So a word of advice on this: do not be in la la land. Do not watch the media. Do not take Hollywood movies for fact, because those are Hollywood movies. And don't listen to random people that tell you they invested in some cryptocurrency and they lost all the money, or they invested in some random penny stock and they lost the money. Of course you're going to lose your money if you invest in a random penny stock. So now let's talk about risk perception. Risk perception often focuses on worst case scenarios rather than realistic possibilities. For example, you see that pretty girl over there, you want to go speak to her, but you're scared and you don't. Because in your mind, you're thinking, if I go and approach her and I speak to her, then she's going to get angry, she's going to punch me, my friends are going to see, people are going to see, I'm going to become a meme, laughing stock, my life's over, it's ruined. You play all this scenario, but that's not real. The only thing that's going to happen is she might say she has a boyfriend, no thank you. Or she might just not talk to you. Or if she's a real, she might be a bit rude, but that's very rare. So nothing like that's going to happen. But your perception is of the worst case scenario. But the thing is, it's not even the worst case scenario. It's a completely made up scenario. The worst case scenario is she says no. You took that and then ran with it. Made it into a whole movie in your mind. And that's the exact same thing when it comes to the stock market. In your mind, you're thinking, I invest in these companies, they lose money, that's it. I've lost everything I've invested. I've lost my whole life savings. But the truth of the matter of fact is that's not the case. Now, sure, it could be the case if you're an idiot and you invest in some random no-name company on a penny stock that you've never heard of because your homeboy told you so. Yeah, you could probably lose everything you have. But to lose money on well-established blue chip stocks like Coca-Cola, Amazon, Tesco's, Walmart, Nike, Apple, Facebook, that's very highly unlikely. And also, for us, we're not investing in individual stocks. We're investing in a index market. It's a broad basket of stocks, which basically means if we have the S&P 500, the FTSE 100, and the emerging markets and the global world markets, we're pretty much investing across the entire world. We're investing in the country's economy. We're investing in America's economy, the United Kingdom's economy, Japan, China's economy. Now, for you to lose your entire portfolio, everything you had, by investing in the whole world, then I don't think money's gonna be your problem, because at that point we're probably under some alien invasion or nuclear wars going on. But outside of those completely nonsensical things happening, your money's not gonna go down the drain, because how likely is it that Apple, Amazon, Coca-Cola, Tesco, HSBC, Barclays, all of these massive companies that have been around for centuries are gonna just collapse when you invested in it? And another thing is that time plays a significant role in investment risk assessment. You see, if you were to invest money today and then pull it out, then for sure you could possibly lose money, possibly gain money. If you were to invest it for a week, for a month, maybe even a year or a couple of years, yeah, sure, you could lose a lot of money. But if you were to invest it for 5 years minimum and leave, or 10 years, 15 years, then the chances of you losing money is very slim. You see, the data shows that anyone who invested in the FTSE 100 for any 10-year period between 1986 and the present day, 2024, had an 89% chance of making a positive return. That means you had an 89% chance of making money if your investments were in the FTSE 100 for 10 years or more. If I told you that if you approached 100 women, 89% of those women, so 89 women, will say yes, will you go and approach them? Of course you will. So if that's the case, then why would you not invest your money? You're literally leaving money on the table. Now, let me tell you the types of investments. There's 3 main types: shares, options, and funds. Shares represents ownership in a business and are subject to business performance. Options provide the right but not the obligation to buy or sell shares at a predetermined price. Funds include actively managed and index funds, which offer diversified portfolios. So, which one should you invest in? Well, that's a personal choice by you. For me, I personally just invest in index funds. I don't mess about with shares or options. Options is just too complicated, and I cannot be bothered to learn that, to get my head around it, to even bother with it. Because to me, if I'm gonna be betting, I'd rather just bet on the football. When it comes to shares, I cannot be bothered to read the entire history about a company, read the financial report, predict that if they're gonna make money, listen to the news, figure out how much, if they're undervalued or not. All that just seems unnecessary and too much work for myself. I'm a passive investor. I just want to invest my money, let it do what it does, and get some return. You see, with shares, you're basically an owner of a business with the potential for growth. The risk varies based on the stability and performance of the company. So, for example, if you were to invest in a company and that company tanked, like a certain online car company's tanking, then you would have lost a lot of money. But on the other side, if you were to invest in, for example, Apple in the beginning days, then you would have made a lot of money. But that's the thing, you don't really know which companies are gonna perform. So it does have the potential for high rewards, but it also has the potential for high risk. Now, if you diversify and the longer your timeline of investments in different companies across different spectrums, then the risk does reduce a bit. But if you decide to just short-term trade, then that's incredibly risky. At that point, you're not investing, you're just gambling. And to be honest, if you're gambling, you might as well just gamble on the football or the horses, basketball or whatever your sport is. With options, contracts guaranteeing the right to buy or sell shares at a future date, they are high risk due to potential loss of premium if predictions are incorrect, and they are not recommended for beginners or intermediates. To be honest, I think they're recommended for Wall Street bet people, those YOLO people. Now let's talk about funds. Actively managed funds involve higher fees and uncertain performances. You see, majority of actively managed funds, they don't perform better than the entire index. So you're paying more money to get an inferior product. Doesn't make sense. While index funds offer lower fees and historically stable returns. They track the market and they perform how the market does. Obviously, if they track the market, that's how they're going to perform. Historical data supports long-term market growth despite short-term fluctuations. So on the short term, yes, the prices of your investments can go up and down. But to be honest, if there was a tracker for your house and you looked at the price of your house price is going to fluctuate daily as well. If there's a news about some crime incident that happened close to your house, then the value of your property is going to go down. But if there's some news about a massive company coming close to where you live, then yes, the price of your house may go up because it presents a job opportunity. So with all that information, you should understand that you should invest for the long term. So minimum 5 years, ideally 10, 15, 20, however long you want to invest for, but minimum 5. So when the markets do go down, that's not a time to sell, that's not a time to panic. That's the time you want to buy, because that's when you can actually buy low, and then hopefully when it comes for you to sell, you sell high. And another thing, not investing in a stock market or putting your money in a high interest savings account which matches inflation, then you're losing money. If you just have your money sitting in your pocket, sitting in your current account, then every single year inflation's devaluing it. So as they say, if you're not moving forward, you're moving backwards. So that was the video. Hopefully it was helpful. If you found it helpful, then give it a like. Let me know in the comments what you thought. Subscribe and take care.